All right, welcome. My name is Thomas Minert. I'm an agent with Exit Realty North Star, and today I have Jared Nicolaisen with me from Key Mortgage. Jared, how is your day going, my man?
Dude, it's fantastic. I'm looking forward to this conversation. Looking forward to Friday, like everybody.
Oh yeah, yep. And then sounds like you just early voted today.
I voted today. Did my civic duty. So I'm,
Everyone, get out there and go vote. Early voting has started. Sounds
yeah,
like it was fairly pain-free.
for me, if you're
Yep.
over the age of 60, it was probably not fun. That's what it sounded like.
Gotcha. So we're here together today to talk about what everyone seems to kind of want to talk to us about whenever they talk to us about the real estate market. Basically, everyone our age or older remembers 2008. They remember the Great Recession. They remember the market crash. I was young enough at the time that I remember it. I didn't really experience it because I was so young and still in school and everything like that. But I remember seeing new construction homes sit with for sale signs on them for 10, 12, 13 months. And I remember some of those big builders at the time going out of business. I remember friends and family members that I had losing their jobs. I remember all of this stuff of the Great Recession. And I remember that it was because we had a real estate market crash, basically, is what caused it. What do you kind of remember anecdotally?
Honestly, not much. I mean, I would just like on my way to tournaments and stuff with my parents. I would hear what they would listen to on the radio because a lot of it was just like news and stuff like that. So I heard how bad it got, but I didn't really feel it just because I'm younger than you are. So
Mm-hmm.
um, I was only 10 or 11 when that happened, so I didn't really understand
Yeah.
until you watch The Big Short, you really don't understand.
Yep, and I'm glad you brought that up. That is, if you want to thoroughly understand it and be entertained at the same time, this is an amazing movie to watch.
So good.
It gives you such a good grasp of what happened, why it happened, and why it was such a unique circumstance. Um, the thing that this has kind of led into, though, is now everyone that reads the national news, all the national news seems to want to talk about the real estate market, and it seems to want to predict that we have started this recession. And whether we've started the recession or whether it's soon to be coming is kind of up for debate. But I think there's really no debate that the recession is coming. It's just how bad is it, and then what factors of the economy will it affect the most?
Yeah.
And this article that I pulled slash that we're going to be kind of talking today kind of talks about the real estate market specifically, and it kind of talks about the term crash, which isn't even really an official real estate term, but it kind of talks about why it won't necessarily be a crash. We're just kind of looking at a correction. Um, Recession doesn't necessarily equal a real estate market crash. Um, since '99, there's been three recessions. We had one in '99, one in '08, and then the whatever you want to call the weird micro bubble that we had in 2020 because of COVID. We had one then. Obviously, we know that the market didn't crash in 2020. We know that it crashed in '08. And it seems like when people say crash, would you agree that most people are talking about double digit percentages loss in equity?
See, that's what I would think. And I really don't know how people would define it, to be honest. I don't even know how I would define it because, and here's why, like 2020, people say market's going to crash. Is the market if our market loses 10%, we're still up 15% from
Yeah.
2019.
Yeah.
Is that a
So,
crash? I don't know.
yeah, it's and it even if we were to drop 10%, if someone would have it all depends on when you buy too, and this is why
Yeah.
they talk about real estate is it's a long-term game. You buy and hold. You don't try to keep flipping real estate because you might get burned. Because
Yeah.
if you look at certain things short term, like if someone would have bought in '07 and tried to sell in '09, they would have lost a lot of money. But
Right.
if someone bought in '07 and waited until 2012, they wouldn't have lost any money.
Right.
And that's kind of why when you're talking to people about buying their own personal home, not real estate investing, you we always talk to people about that 5 to 7 years because of the market and because of just the way home mortgages work. And once you start getting past that year 5 is when you're finally starting to flip that equation as far as how much interest you're paying in your monthly payment and stuff like that.
Mm-hmm.
That's a lot of stuff that doesn't necessarily talk about this article, but it is an interesting point to bring up.
Yeah.
Before we get really into it, I just wanted to ask you really quick because I just had someone bring this up with coffee. The Fed obviously made their announcement recently that they're hiking the Fed rate again. Do you want to kind of explain how lenders have kind of already baked this in, so to speak, and kind of
Yep.
anticipated it already?
Yeah, so obviously mortgages operate in the secondary market, which means when you buy a house, most likely you're going to go through a lender and it's going to get sold to somebody else, meaning somebody else is going to service that loan. Those loans get bundled up into bonds and sold in the stock market, where long-term investors, they buy these mortgage bonds because it pays, X percentage out every year. So when these bond investors are buying, they're already buying based off of what the projected rate hikes are going to be. So therefore, our mortgage rates are determined by these bond rates. So, when the Fed has been saying since like August or September that they're going to raise interest rates by 75 basis points in November, that was already taken into an account right when they said it. So pretty much all the rate hikes that they've announced are already priced in.
Yeah. And the thing to watch, and the thing that I kind of try to read whenever the Fed announces one of these rate hikes is, did they announce something higher than what they had previously projected? Because that's when you're going to see the changes, because no one anticipated it. So
right now you're seeing a more of effect on mortgage rates based off of what the Fed is saying rather than what they're doing, if that makes sense. So when the Fed, like for example, Jerome Powell said that raising interest rates, we haven't seen as much of a drop of inflation as he'd hoped. That's going to do more to the market than him raising 75 basis points.
Gotcha. So we'll get into this article. This article is from BAM Media. They do really good job of just simplifying real estate news for people. So it's a great website to check out if you ever do. But basically, they did this article asking, will the market crash? And then they have 5 experts saying 5 reasons why it necessarily won't. They start off this article talking about, on a national level, experts are kind of looking at right around a high single-digit correction coming. And the important thing to keep in mind when you're talking about the national level is the biggest pushers and pullers of that type of number are your coasts, where a lot of people live and where real estate prices are the highest. So you get a big correction in California, that's going to make the national number look a lot different than if you get a big correction in Iowa, so to speak.
Yep.
So when they say 8 to 9%, just know in your central Iowa area, it's might not even be that high of a correction. So
right.
So the biggest thing, and I did a video actually earlier this week talking about the big problem that we're still going to be seeing in the real estate market, is inventory is still very, very low. Some markets will see a price decline, yes, but with supply not being there, repeat of 30% price decline is highly, highly unlikely, says Lawrence Yun. Lawrence Yun is the chief economist of NAR, the National Association of Realtors. He's kind of the number geek that they have, so he always gives opinions on stuff like this whenever there's interest rate news or big market news and stuff like that. So when he's talking about a crash, he seems to be putting out a big, way bigger decline than a lot of people would think. But the biggest issue is we're just not going to see a high enough jump in inventory to make a big correction noticeable. And I don't know, you own your place, right, Jared?
I do.
So, and I'm assuming you got a pretty good interest rate on it.
Yep.
So unless you get an amazing job offer in Minnesota, with the interest rate that you have on it, why would you sell right now?
Right. Yep.
It's kind of the thing. 85% of people in the U.S. right now are projected to have mortgage rates like below 4.5 right now.
Yeah.
So if you own a mortgage, it's just going to start getting back to the much more normal market where people are only going to sell if they have big life changes. If they have more kids and they need a bigger house, if their kids move out and they need to downsize to a smaller house. I would even argue that some of those people might hold on to their big houses convenience sake wise too. But downsizing is definitely, I can see some people do, or just relocations. It's going to get back to those kind of three basic things.
Yeah.
I think, yeah, okay. This is going to get back to the next part of it too. New construction is too low to meet demand. So I don't know how much you watch this, Jared, but new construction, they're just not going to be building at the rate that they were building the last 2 years, obviously.
Yeah.
And for people that haven't looked at it, after 2007, they built at basically an unprecedented rate. The market crashed, obviously. And we've never even got close to building at that rate again.
Yeah. I think there is a stat, and I'd have to look at it and try to find it, but there is a stat where there is a level of homes that need to be built to sustain, a certain level of housing market growth. And I think for the last, probably since at least 2018, we've been under that level, and it's been pretty like significantly enough under that level where it doesn't look like there's going to be a quick change.
Yeah. And the thing to keep in mind too, and this is more of an anecdotal point that I want to make too, with the way interest rates were the last few years at an unprecedented low. I know all of our real estate agents sounded like broken records when we were bringing this up over and over again the last few years. Historic low interest rates. It made it much more possible for a first-time home buyer to buy a new construction home. And when you have interest rates jump as high as they had, that really decreases the affordability, and that probably hurts the first-time home buyer more than basically anyone else. And it made that new construction home not possible for a lot of first-time home buyers all of a sudden. And because of the market demand that there was the last few years, the homes that were being built by these new construction companies were homes pretty much basically built for first-time home buyers. And now all of a sudden they're in a market where those homes aren't quite achievable for first-time home buyers.
Yeah.
But all these homes that they have, unfortunately, in my opinion, aren't quite enticing enough for people that are looking to upgrade.
Yeah, I agree.
If that makes any sense. So they're sitting on a lot of inventory that they really just don't have buyers for right now. And the reason that that's kind of important inventory-wise is we kind of get those homes for first-time home buyers by people upgrading into bigger, nicer homes. So if you have these people that own their first home and looking to get into a second home, but none of the new construction is appealing enough for them, that kind of puts us at a tough point inventory-wise. So it's creating kind of an interesting little situation right now. Les Solgrove just did his weekly update on Monday, and I was watching it. And for resale homes, so people selling their homes that they currently own, we're still at a 2 months inventory. And for new construction, we're at 13 months. So it's just a big difference in those markets right now. So it's becoming a really interesting market. So it'll be interesting to watch new construction the next few months or so and kind of see what happens, what creative solutions they come up with to get rid of the inventory. But I can tell you right now, as far as permits that they have out for new builds, it's like a third of what it was last spring is what they're looking at. So basically you're just going to be, a lot of those builders are going to try to sell the spec homes they have, and then only new orders that they're going to be doing are built to orders or custom homes. So
just wait a little bit.
One of the other reasons that we're not going to be seeing a big correction too is, unlike in 2008, it seems like there's a lot more new buyers entering the market than there was back then. Millennials, which I believe are the second biggest generation in the U.S. population-wise right now, all millennials are still pretty much at first-time home buyer range, and we have Gen Zers starting to get into the age where they're going to be buying homes too. So what's the specific stat that they threw out in this article? Millennials and Gen Zers are joining the ranks of first-time home buyers who, as a group, were responsible for 30% of home sales in June 2022. up from May's 27%. I would expect that the rate of purchase you're going to see, I would expect first-time home buyers are going to be making up more and more of the buy-in market. Because I think in most markets, when you do, even with, for some people, even with the interest rates that we're at now, if you do the analysis of renting versus buying, I would still bet a lot of people are going to make that decision that, hey, it's got to be a good deal, but I would still rather buy right now than rent in this market.
Yeah,
So,
and plus a lot of times when people see that they're getting more value in the real estate market, so prices going down, that does attract first-time home buyers statistically.
yep. And the thing to keep in mind is there's so many different factors that go into making you buy. Buying at a good price is such a good thing to do long term wise, right?
Hmm.
I don't ever want to tell people the cheesy cliche that people say where you marry the house, date the rate, whatever, because you can't bank on rates going down, but in
Right.
the long term they eventually will go down. We just don't know when.
Yeah.
So you got to be comfortable with the monthly payment that you're getting yourself into, but hey, I got a screaming deal on this house. I'm going to be in it for at least 5 to 7 years. Eventually the rate will go down and I'll have got this really good deal on this house. So eventually you'll get to a point where you have a good loan product and you got a great deal on the house, and that's how you build equity.
Yep.
So
Yep. That's a great point.
and if the equation's much different for a first time home buyer, right? Because you don't have to try to sell in the market.
Hmm.
So it's whereas someone looking to buy that second home, okay, they more than likely have to sell. So they have to be like, okay, do I want to try to sell in this market just to get a good deal on buying? So
Right.
whereas first time home buyer, hey, it's just a good market to buy in, I'm gonna buy. So
Yeah.
so that's something to keep in mind. So this is bringing up The Big Short. That's a really good movie to watch to talk about this, but lending standards are just so much more strict than they were in 2007. I'd never heard this term before, but they referred to them as basically as liar loans. Were fairly common back then when borrowers claimed a lot more income to qualify for mortgage agreements than they could actually afford. It was kind of the Wild West back then. They It was all based on stated income. Appraisals got wonky. Appraisers were willing to appraise houses at a higher value than they really were. So just the numbers were so inflated
Yeah.
on everything, and it just made everything go out of control. Arms with really bad terms were a lot more popular back then too. You were looking at arms that were only fixed for 2 to 3 years.
And
It
interest only loans, which is another thing that caused issues.
Yeah, people just didn't have a ton of equity. Um, and when you don't have a ton of equity, the second prices start to drop, that's when people make bad decisions, or that's when people just
Yeah.
that's when, honestly, strategic foreclosures were a thing. Like
Yeah.
just bailing on the house. Like in general, like it's a sinking asset. I'm just gonna walk out. Like
Just like the stock market, dude. It's just like a lot of people feel like you cut your losses, but if you're in it for the long term, you should be okay. But it's different with a house because you do have a payment and stuff like that. But you don't lose money until you sell.
right, exactly. So that'll be a big thing is you're not looking at people losing equity as quickly, and people won't be holding bad mortgages basically.
Yeah.
So when you're not holding a bad mortgage, a lot of people I imagine right now are holding fixed rates. Actually, I know that's true. I think I forget where I saw the statistic, but I think right around 92% of mortgages out there right now are fixed rate mortgages.
Yeah. And
So
on the news, you'll see headlines like, "Oh, foreclosures have gone up like 6,000%." Like I
yeah,
see that, but it's still. I had made a video on this, but it's still 40% lower than what it was pre 2020.
yeah. So this is the chart that I found as far as foreclosure rate year to year, year over year.
Yeah.
So 2021, 2020 were really, really low. The thing to keep in mind too is there was a lot of mortgage forbearance programs going on. So they kind of kept it artificially low. But they haven't even got back to, just like you said, they haven't got back to what they were before 2020, before COVID. Um, so the thing to keep in mind, just like you said, is we're going to start to see articles where they say, yeah, they've jumped 600%. Well, they're fudging the number. I mean,
Right.
if you're looking at upping 600% of
Month
0.11,
over month, right? And it's month over month. It's not over like year over year.
yeah. I mean, but like, yeah, you take that 0.11 and up that, it would go 0.66. That wouldn't even get you to what we were in 2016 as far as foreclosure rate.
Yeah.
So it don't be misled by the headlines. Actually read the articles. You're looking at, and during that recession, you had a foreclosure rate of mid twos ish or low
Yep.
twos. And this is a national number, but I would venture to guess that Central Iowa's was a lot less than
So
this.
a lot lower. Yeah.
Yeah. So don't get freaked out once you start to see foreclosures go up. They probably are going to go up because some of these forbearance programs are going to start to end. And unfortunately, some people, it looks like even after the stimulus and the help with the forbearance, they're probably going to have to foreclose on their homes. But there's a certain percentage of that just happens in every market. So,
yep. And you can see it's been going down since lending standards have gotten more strict. So
yeah.
There's probably going to be a number that it kind of sits at for 5 years, and we haven't even seen that number yet.
Yeah, and we don't really know. I guess you might have a decent idea of this. Are they always? I mean, obviously, it was a huge change in lending standards after 2008. Is
Yeah.
it always getting more and more strict, or is it kind of just stayed the same basically since 2008?
I think a lot of it depends on like the market, like
And who the creditor is, probably too.
right. Yep. So during 2020, 2021, I wouldn't say the rules don't change, but the algorithms to approve a loan versus not approve a loan, like those change between who's going to buy between Fannie Mae and Freddie Mac. So a loan that they would have taken in 2021 and 2020, they probably may not be taking right now because it's just more risk.
Not a good risk to take on. Yeah.
Yeah. So it's all risk tolerance. And so their algorithm is constantly changing, I'm sure.
I think we just got people room for people to ask us questions at that, but hopefully that kind of clears things up for people to kind of talk about. It'll be really interesting to watch in the next few months. I feel like like we were talking about before we started this online. I mean, at the end of the fourth quarter, I think will give us a really clear sense of direction as far as what's happening.
Yeah.
In your opinion, Jared, what are some things that people could watch if they're really interested to kind of try to get a feeling or a temperature of where the market's going to be heading?
I think stay off of national media. And it's not because national media is bad, but when you look at a very 50-state approach of the whole market, I would say the best thing you can do is look at your own market.
Yep, or at least be cautious of certain states that can throw off those numbers.
Yep.
Because my general feeling, reading national real estate people and what they're thinking, the general feeling is all of these states and markets that made so much money from this COVID boom, you're going to see a pretty hard inverse for those markets.
Yep.
So they're talking about like Arizona, they're talking about Las Vegas, they're talking about like Salt Lake City, all of those places that people moved out of LA into. They're talking about it's basically going to flip.
Yep.
And then a lot of people move to Florida, a lot of people move to Texas.
Yeah.
Some of those markets, unfortunately, might be standing to look at a really, really big correction. And if they get a really big correction, there's a lot of people that live in Las Vegas. There's a lot of people that live in Arizona that can make the average numbers look a lot worse than they really might be here.
Yeah. Yep. And there's a good report through Black Knight that kind of gives state-specific data. Not exactly, but Black Knight's a very big one. That's to a lot of big like Zillow's, Realtor.com, HomeBot, like that's where they get their data from. So stuff like that. I think follow either one of us on social media. I mean, we're obviously tailored in Iowa, Central Iowa, and the Midwest in general.
Yeah.
And I think anytime that you can talk to a local expert it's just gonna give you value, that's important.
Yeah. I'll throw this out there too for stuff to watch. I think obviously inflation, that's the biggest thing that we're trying to fight right now. So if we start to see inflation rate go down, that's obviously going to start to be a win. And that starts to mean that the Fed rate increase is starting to work. And then I think unemployment will be an interesting thing to watch too. So,
yeah, for sure. But awesome, man.
it's a great video. Went a little longer than I thought we did, but it was because there was just so much interesting stuff to talk about. And obviously,
Yep.
people have made movies about this type of stuff, so we could talk forever. But I appreciate you getting on. Anyone that has questions, please, even though we're done with the live, please leave them below. We will answer them on the next video, or we will leave a message in person.
Yep.
Figure stuff out for you. We're always here to talk about the market, and I hope everyone has a great day.